So now that we know a little bit about the accounting equation, we're ready to kind of look at how different transactions, business transactions will impact the accounting equation. So I'm just going to step us through a series of transactions and discuss how each transaction impacts our accounting equation. For me, it helps to have a process. So when I see the transaction, I first ask myself what types of accounts are involved. And then ask myself, are those accounts increasing or decreasing? And then I'm ready to see how those impact the accounting equation. So in our first transaction, the owner, C.Taylor, invests $30,000 cash to start his new business. I guess it's his, it could be his or her business, to start their new business. The accounts, so I would say, well, what's happening here? So for the business, the cash is increasing. And then our equity, which we're going to just call capital, that's the amount that the owner puts in, is also increasing. So we'll say cash increases, and cash is an asset, and equity increases. So we can see here, looking at our accounting equation, that our cash goes up by 30,000, and our equity, the capital by the owner, it goes up by 30,000. And you can see that our equation is in balance. We always have, remember, assets equal liabilities plus equity. So there's always the same amount on either side of that equal sign. So let's take a look at another equation, or not another equation, but another transaction. So transaction 2, we purchase supplies for cash. So again, what happens when I purchase something for cash? Well, I guess my cash will go down and my asset called supplies will go up. Remember, an asset is something the business owns. So the cash goes down and supplies goes up. So now we can see on transaction 2, a decrease in cash. You'll see that shows it in parentheses there. That's one way in accounting that we say something is negative. Other times you'll see it actually like a negative sign, but when they put it in parentheses, that means negative. And so as cash goes down, supplies go up. Our overall assets are still 30,000. And our equity is still 30,000. So we're still in balance. Transaction 3, we purchase equipment for cash. So again, when I purchase something for cash, my cash goes down. And whatever I'm purchasing, if it's an asset in this case, like equipment, it goes up. So here we'll see on transaction 3, the cash goes down 26,000 and the equipment goes up 26,000. Still 30,000 in assets. We've just, it's no longer all cash, right? We only have 1,500 in cash, 2,500 in supplies, and 26,000 in equipment. And it's still in balance, and that's important. We always have to have assets equal liabilities plus equity. All right, transaction 4, we purchase supplies on credit. Good thing too, because we're almost out of cash. So credit means that our supplier is allowing us to pay them later, right? So we're going to owe them. So our supplies will go up. That's an asset called supplies. And then a liability called accounts payable, which just means money I owe to my supplier, okay? That also goes up. So it'll look like this. Supplies will increase by 7,100 and accounts payable will increase by 7,100. And our total assets will increase to 37,100 and our total liabilities plus equity will equal 37,100. Everything's still in balance. Let's see. So now we're going to look at revenues and expenses and withdrawals. So revenue is just money that the business makes through selling stuff. That's what businesses are in business to do, sell stuff to earn revenue. And expenses are money that the business expends as part of its operations. Just in the process of earning those revenues, there'll be some costs. Those are expenses. And then withdrawals are a little bit different because that's money not that we're spending on operating the business, but that the business owner is taking out of the business, because why else do you own a business except to be able to take some money out of it every once in a while? All right, so transaction 5, we provide services for cash. So looks like we receive $4,200 from a customer. So our cash is going to go up, and our revenue, which means money that we've earned, will also increase. And so here we can see how that impacts our balances. Cash goes up by 4,200. Revenue goes up by 4,200, and we're all in balance. 6 and 7, we have payment of expenses for cash. So we paid our rent of $1,000, and we paid salary of $700 to employees. So our cash will go down, and our rent expense will go up. This is a little confusing because expense accounts, when they increase, that actually reduces our equity. And so that sometimes that can throw people off. And so you can see right here how they have it shown to you with a green arrow showing the rent expense is going up, but a red arrow showing that our equity overall is going down. And the same thing with our salaries expense. So here we can see cash goes down by 7,000 in transaction 6, and expenses decrease the equity by 1,000, and cash goes down by 700 in number 7 there, and our expenses decrease the equity by 700. And remember, as always, everything has to balance. Assets must equal liabilities plus equity. Transaction 8, we provide services and facilities for credit. So this time we're doing some work, but we haven't yet received the money. Okay, so this is an interesting thing about revenue, is we talk about revenue, we earn it when we do the work for it, okay, or when we provide the services for it, not necessarily when we get paid. So in this case, we're going to have an asset called accounts receivable. It's a special asset. That means we didn't get paid cash, we got paid the promise of payment in the future. Okay, someone's going to pay us later. So whenever someone owes us money, they're going to pay us later. We'll call that accounts receivable. And then we'll record our revenues for the money that we've earned. So you'll see the asset accounts receivable increases, and our overall assets increases to 41,500. And then our revenue accounts increased by 1,600 and 300. And the reason they did that, let me go back up, is we usually like to record our revenues separately for different types of revenue. We'd want to keep our consulting revenue we've earned by doing consulting for someone, separate from our rental revenue we've earned by renting things to people. Again, all in balance. Transaction 9, the people who owed us money from transaction 8 have now paid us the $1,900 they owe us. So when that happens, our cash will go up, and our accounts receivable, the money that was owed to us, will go down because it's not owed to us anymore. Now it's been paid. So here you'll see cash increasing and accounts receivable decreasing. And again, everything's in balance. You'll notice in these scenarios where our cash and accounts receivable, one goes up and the other goes down, there'll be no change to the liabilities or equity, because we're just doing all of that transaction on the asset side, one asset going up, the other asset going down by the same amount. You saw that earlier when we purchased equipment for cash, right? Equipment went up and cash went down, but there was no change to liabilities or equity. All right, transaction 10, we pay $900 as a partial payment for the supplies we purchased back in transaction 4. If you remember, we got supplies but hadn't paid for them yet. So if we're paying for it, what's happening? Our cash is going down, and our liability, accounts payable, is also going down. So again, we'll see a decrease to cash and a decrease to accounts payable, and our overall equation will all be in balance. All right, one more transaction here, I think, and then we're done with these. There are a lot, huh? Withdrawal of the cash by the owner. So the owner pulls $200 out of the business for their own personal use. So when that happens, the cash goes down, and a special account for our equity, called usually the owner's name, withdrawals, will go up. And just like an expense, those withdrawals, even though the withdrawal account we say is increasing, that's actually going to reduce the equity. So again, that's a little confusing until you get used to it. So again, we can see cash going down and our equity going down with the Taylor withdrawal, and then everything's still in balance. And at the end of this long month of transactions, you can see in this summary, all of the transactions sort of summarized. Down at the very bottom where it says balance, you'll see we have $4,800 in cash. We have no accounts receivable because we received all of the money that was owed to us. 9,600 in supplies, 26,000 in equipment. We also still owe $6,200 in accounts payable. The owner put in 30,000 and withdrew 200, and the business earned 6,100 in revenues and paid 1,700 in expenses. So there's a summary of the transactions, and hopefully you have a little better understanding of how transactions impact the accounting equation.